Okay, looks like my mic's working now, so I can redo the video. So what this is, well, first of all, smarthelping.com here. Welcome. I build financial models for all kinds of businesses and use all kinds of logic. And what I have here for you today is a 5-year financial model for recurring purchases plus an inventory batch modulator. What that means is if you sell products to customers and those customers, a certain percentage of those customers that buy your product every month will repurchase for a given amount of months in the future. That logic is pretty difficult to build assumptions for so you can test different things, but I've done it. Secondly, we've got inventory batches. So that means if your products you're selling, now if you don't have any inventory, that's fine if you're drop selling or whatever. But if you are, you have a manufacturing cost per unit, and you have to outsource. Let's say you're outsourcing that, so you just pay somebody. It's a straight up cost per unit. Um, you buy everything in advance for the batch, and then you sell it. Well, this uses your sales prediction. So based on the assumptions you put in here, it gives you unit sales that you're going to need, which would be new sales and recurring sale units. So it counts for both. And you can put in assumptions to say, well, if I want to buy uh, from the sales that I'm going to have from, let's say, February to April, so 3 month period, I want to buy that inventory 2 months prior. Well, I've got the logic built for that. You can put in those assumptions, tweak it, and it will come in through the monthly and annual cash flow summaries. So let's get into it. This is just the index page that explains what each tab is. In general, as all my models are, the light yellow tabs are where you're going to modify your inputs, and then everything else auto-populates. So first things first is revenue assumptions. The start date of the project, which it doesn't matter what you put here, it's just gonna, all it's doing is it's pulling the year that you put in here, and then it's populating the months that your project is going to encompass. And it always starts with the first month of the year you plan on having operation start. And that's because to make it work universally, no matter what situation or whatever, or who's projecting, your time frames, your first year of the 5-year model is gonna be short if you start in operations in any month other than January, which is fine. Because it's going to be accurate then and show your year one. If you start in June, well, it's only going to be from June to December numbers. So your year one will be shorter than the other years, and that's represented accurately. That's the simplest and most straightforward way if you're going to present to investors or trying to work it out how it looks in your head. That's what I found is best. So that logic is done. Next is your month of revenue. So this is important, and this will drive your entire model. The actual first month you plan on sales happening. Let's just put it at let's say April for now. And when you do update this project, let's say you can see the drop down here starts in 2018 January. If I were to put this, let's say June of 2017, you can see the drop down actually updates now to start in the first month of 2017 and go to 2020, whereas in 18 it started in 18 and went to 2021. So it's always going to be a 5-year period. So the first major assumption for revenue is going to be your sale price. So what's the average sale price you plan on having for your unit? You could put in anything here that is accurate for your particular situation. We put in $8.49. Next major assumption, and this is how I've done the revenue. It's pretty straightforward. You simply enter the sales you plan on having in the first month, and then from there you put your monthly percentage of growth for each year. So this is saying in year one you're going to grow from the starting amount 20% per month. and then year 2 you're going to grow 10%. 10%, 2, and 1. And the reason why I have these going down is because it's exponential growth, so it compounds. And if you went 20, 20, 20, 20, 20, that's not growing year over year, that's growing month over month. So if you put 20 in each of these, that's saying that every single month you're growing 20% more. So if you did 10, next month you do 12, then you do 20% more of 12, and then whatever that number is, you do 20% more again and again, and that growth can basically get ridiculous. So I've just put a decent, moderate numbers in here that make sense. What you'll do when you're building this is you'll test different growth rates and see if the numbers look like about what you think you're going to be able to do, and that's how you play with the numbers. So there's that. Next part is the repurchasing. So this is the first big logical functionality that we've got here. So repurchasing, this says the amount of customers that you think will repurchase, so at 10%. That's saying if I have 100 sales, 10 of those people will buy again next month, and they'll do that for 6 months going forward. You'll have to run some numbers and figure out what your average length of months that customers repurchase for, but the key is you've got the ability to adjust that to whatever you want and see how that makes the numbers look and how it affects your unit sales, revenues, everything. Next thing is licensing. So this might not necessarily be relevant to you, and if not, you can just put in zeros for these. But if it is, then you can put in numbers. And this just says, pick the month that you plan on the licensing deal starting, and pick the amount of units you plan on that deal having per month, and then pick the amount of revenue that you get on the deal for every sale. And then based on that, you'll have a monthly revenue here, and that also populates the monthly and annual summaries. Okay, so that's everything for revenue. The next is, well, actually, let me show you, now that we've done the revenue logic, let me show you the retention schedule. So this is all formulas here, and this is how I've built the logic. So real simple here, you've got, we started the sales in April. You see here, April. If we change that to March, then this would change to March. You see there, now it's 1 month back. So it's just in all these, all update. So this is saying, based on our scenario, we put in 10%. So the 1,500 that bought in March, 10% are going to buy again. So here's our reorders. Now here's the hard part. If you go in April, you've got another 1,800 of new sales. You repurchase. And then in May, now you've got the repurchases from the 1,800 and the 1,500. And that's where this model really shines, because it gives you everything. You can see if I did 10% of this is 180 plus 150 from the 1,500 comes to 330. And that's where this is calculated, even though this pulls all the way down from down here. And then you go on again. You've got June, so now in June you've got your new sales for June, and then you've got all the repurchases that happen from these customers, and these customers. So now we've got 546, which should be the 330 plus the 150 plus 10% to 2160. You want to check my math or my logic, you can see it does work. There's the 216 from the 2160 plus 330 plus 156. Oh, hold on. What was our... They're repurchasing for 6 months. What happened here? What did I do? 150, 330. Well, let's see. What do we do here? Let's get down into the logic. 150, 216. For that month. right? So 150, 180, and 216 is 546. Is that what I got? Am I losing my mind? 216 plus 30 plus 150. What am I doing? Am I losing my mind? That says 690. Now hold on. 330 and 150. 150, 330, 216. What am I out by? Oh, I've been on these spreadsheets too long today. I'm out by 150 for some reason. It's 150 higher. Why is that? 150. I mean, there's the numbers. 150, 180, and 216. How is that coming to 546? Let me do something here. Oh, I really don't want this happening in the middle of this, but now that's 546. So what in the world? But that's 696. Alright, are we in the twilight zone here? What the heck? 150. 180. Oh, hold on a second. 150, 180. What was I doing? Why did I put 330 here? Oh. Duh. Oh my goodness. I can't believe I just did that. That's really confusing you guys, and it made no sense. I shouldn't have done that. The 330 is from this month, and this is why this model is so helpful, so you don't make these errors. That should not be 330. This should be 10% of this. Or, sorry, 10% of the 1800. So now, because we're getting 10% of the 15, the 18, and the 2160 that comes into June, right? So that total is 546, which that is the right number. Holy cow. Alright, and that's how it goes forward. And then you can see it drops off when the 6 month it stops. So you can see if you go over here 6 months, 150 stops 1, 2, 3, 4, 5, 6, and then it stops. None. So in October, the 1700 is no longer taking into account the reorders from March's sales, but it's taking everything else. And that's how it goes through time into perpetuity. Okay, so that's that. I'm pretty sure you guys got a good understanding of what is going on there now. Now if we go to cost assumptions, pretty straightforward. We have our cost per unit. You just enter that there. It's a one entry. And then you've got your running fixed costs, such as the CEO, COO, general manager, rent, whatever costs you have that are just fixed. You can pick the month you plan on them starting. So obviously, if you don't want the CEO to start until, let's say November, and the COO until, let's see, March of 2019, and you put their monthly, fully loaded monthly costs here, and that will all populate. Then we have, alright, this is our second major logical situation, and I hope I don't screw this up in explaining it, but it's supposed to be, in my mind, the easiest way to plan for inventory in the most dynamic way. So what this does is this auto-populates based on whatever the first month of revenue is, and then everything else is driven by what you put into here and here. So high level, it's saying for this period of sales from March to July, you're going to sell a certain amount of units, and those units will have a cost. And this is saying the amount of months prior to when those sales start do you want to pay. So then you got this logic that says, okay, period 1 is going to be from March of 18 to July of 18, and I'm going to pay for that inventory 2 months ahead. So in January. So January 18, I'm going to pay for it. March is going to start those unit sales, and it's going to go to July. Now I can change these if I say I want to pay for the first 20, let's say the first 36 months of sales I have. So now that's going to say in January, I'm going to buy all of the units. I'm going to make all the planned units I plan to sell from March of 18 to February 2021. All, I'm going to pay for that all in January. Now, if you want your time, let's say, let's see here. Now, and this is where it's helpful to have this logic that I showed you at the beginning, because let's say you wanted to actually have your lead time in 2017. You put 2017 here, and then you can say, okay, I want to pay for March of 18 to Feb 21. First of all, let's say our sales are going to start in, yeah, we'll do March, but we'll say my lead on that, I want to be 4 months. So now it can give me a November 17 date is where I'm going to actually make my first purchase of inventory. And then March of 18 is when it starts to sell, and that goes for 36 months. And then you could just keep going down the line and make every period. I just did it, let's see, how do they have this set up? I just did it 5 at a time, so it was just, you know, basically every 5 months you're paying for the next 5 months of inventory. And lead time here I did 2 and then 3 months. So at 3 months it's saying, okay, I paid everything through July. Now August sales start, and I want to pay for the units I plan to sell in August and December, and I want to pay for that in May of 18. 3 months ahead of when it planned. So this is a really nice schedule. It allows for the easiest input, and then all the dates populate based on that. Okay, and I guess that's, oh, and then there's financing. So this is if, you know, you can put this at 0, but if you want to finance some of the capital requirements, you can put the financing amount, loan term, percentage rate, payments per year, and the date it starts, which will auto update based on what date you plan on this being, and that will all flow through the monthly and annual cash flows in the that are like right below the P&L, within the P&L tabs, and the business summary as well. So that's all auto. You can change this and it auto updates through. Now let's look at the monthly P&L. So I broke it down. Basically, top line is your new sales, then you've got your reorder sales, and you've got the dollar revenue from those, and then you've got your total unit sales, dollar revenue combined on everything. Then we've got the licensing revenue, and then we've got the total revenue, which is basically just licensing plus the base revenue of unit sales. Then you've got cost of goods sold. So this is taking into account all of the total unit sales times your cost of goods sold. And this is very important because this is used for that period purchase guide or schedule. After cost of goods sold, you got gross profit. You've got these operating expenses. And then we've got our EBITDA. Now after EBITDA, we want to figure out the timing of the cash flows. So here's that cash requirements for inventory. This is saying, you know, January we're going to buy 12,994 units, which should be the units we're going to make from March of 18 to July of 18. So March to July of 18 should be 12,994. Let's check that. March to July, 12,994. Perfect. And all this all auto updates with formulas, which is the nicest thing. So you just play with these numbers and then everything all auto populates. If we wanted to put this at 24 months, now the number should be much bigger. Oh, yeah, it is 390,000 units because that's how much we're planning to sell from March of 18 to February 2020. So, and now you can see one big purchase, 1.2 million, and then no more until December, which should be the month after we stopped on the first period. And it is December here. Well, actually, it's not the month. The period ended in February of 2020, but because the next period would be March, but we want to pay for March in December. So we have a payment in January, a payment in December, May, and it goes down the line. And then that covers these periods. So then we've got our running cash position based on that. Here's our debt service that auto-populates and updates all formulas. Here's our financing amount coming through because it's happening in January. Cash flow, and then running cash position after debt service. So we got this, and this is going to be important to calculate your leveraged internal rate of return instead of the non-leveraged, which would be based on this. The 5-year P&L is the same exact thing I just went over, but it does everything on an annual basis. And now you can see these inventory purchase batches here, which is pretty cool. And then you can see your total unit sales right there. And it's really nice to show, basically you can see, okay, what money am I putting out and when, and how many sales is that going to generate, assuming I sell everything I make. And it's a model, so obviously it's not going to be perfectly accurate, but it's supposed to give an idea of what you plan on doing. So then we got the business summary, and this is, you can put this into like a nice little page format or however you want, but the key is to show some high level metrics. And so I just did, top line revenue, cost of goods sold, gross profit, operating expenses, EBITDA. Real simple. Everybody, these are easiest line items to understand. It represents what you plan on doing for the next 5 years. Now we get a little bit more complex with the implied minimum investment. So this is saying without financing, in order to stay alive, you need $1.3 million of capital. And with financing, you only need 540. And you can see, and this is the case normally, is when you finance, your internal rate of return goes up because generally you're getting a higher rate of return on your capital than you're paying an interest rate. So that means that you're getting less capital back than if you had put all the cash up front, but you're putting a lot less capital into the business to get that return. You're putting 540,000 in instead of 1.3, so your internal return is 168. And you can see on the annual here, you're getting less. You're only coming to 11.395. Without financing, you're actually getting to 11.467, and that's including. This is including the you're paying out debt service. And this is lower because you're paying out debt service, and that's the main reason. 360,000. Let's see what's the difference here. But I see. You're paying out debt service, but you also have a little bit more cash coming in up front because of the financing of the 775 here. So it ends up, you get a little bit less cash back, but you put a lot less down up front. See the 540, whereas initial investment 1.3 million without the bank. And your returns are higher. Your cash return is higher, but your actual rate of return is higher when you finance. You get financing. That's why financing is good. If you can get a good rate and you actually plan on making these sales happen, or the likelihood is good that it happens. And then that allows you to actually do more. So say you wanted to invest 1.3 million of your own money, but you also want to borrow, say, 540,000. That would then allow you to scale up much higher. I mean, if you wanted, put these at 3,000. See what it looks like now. Yeah, now at 3,000 units, you would have to put up 1.8 million yourself, borrow 775, but now look at your return in year 5. It's 23 million, 17 million. That's much higher. You're getting some nice numbers here, 47 million. Whereas before, oops, let's undo. Let's back to 1500. Now you're only getting about 23 million instead of here. Your EBITDA total was 47 million. So that's just, that's all the ways you can tweak this to see how it affects your returns and IRR, cash flows, everything. This is really designed for you to cash flow plan, and based on your ramping and your financing and everything, you can really see what kind of effects happen based on your unit sales. And if you hit your unit sales, you can see what kind of things you can afford, like paying people to do things, or scaling up the business. So lastly, so that was a business summary. Lastly, we have visuals, and this is really nice. We have key metrics, so total revenue, cost of goods sold, operating expenses, EBITDA. Straightforward, the main metrics right there. It's in a block, so you can see the biggest here would be revenue, and then EBITDA is next. You got your operating expenses in the middle. Cost of goods, or cost of goods sold is the big one actually, and the smaller one's operating expenses. But it's nice to see how much each one is in proportion to the other, and then kind of where you're at here money wise, what kind of scale you're doing. Then we've got unit sales, really straightforward again. You've got your reorders and your new sales. It shows you, each year where you're at. Then we've got base versus licensing fees. Obviously licensing fees are not much right now. If we put this up to say 500,000 units a month, 1.5 million, well, then our licensing revenue is a bit higher. Let's undo that compared to what we built for our this initial revenue. Okay. Annual licensing deal revenue. So this is just saying if you do the licensing, here's what each deal is going to bring in. And what, on a time basis, you can see this. If I put this to 2018, it would go there. They popped in for 18, so you can adjust based on the years you plan on doing those. Purchasing batches. So this is just the amount of inventory you're buying each year based on your assumptions, and then the actual cost of that is here. And then we kind of fall into the cash position. So this is based on your initial cash outlay, non-leveraged. This is non-leveraged. Shoot. And that was my wife yelling at me to come to bed. I'm almost done. Okay, so this is non-leveraged. Select data. Let me just make sure. Yeah, that's running cash position. So that's before debt service. So it's assuming you're financing everything with euro money. And that's good to see. It just basically kind of shows if, you put all your money up front, what does that look like when you break even? And then, these are the inventory buys here, every one of these little downticks. And then here's the timely cash flows. This is showing your cash flow each month. So again, that big period here is coming out, and then we have some positive, another big inventory purchase, and then we eventually break even on this, right around there, which lines up with this. You can see this orange line is the same as this. I just put this on its own so you can see it individually, but then also together with the actual monthly cash flows and the accumulation of that. Now, if we were to switch this back and put this back to 5, you can see the effect on this visual. Now you have your bigger inventory purchases happening as you grow, and you can see how that affects all of these. And this is 0 because now, based on the schedule in 2022, your last purchase is actually, you're covered through April of 2022, and your last purchase is in September. Now to Justice, it says, well, you've actually not accounted for all the costs. So we would need to put this cash, let's say if we do 6. That gets us, there we're at December. So the last month, if we go every 6 months on that. And then now we got a number for 2022 as well. And then here's the loan schedule. This just updates based on what you put in the assumptions and the cost. And we'll hide this. Alright. And that's everything. I think we're really, I've clearly explained what this model can do. I think it's got a lot of use cases for lots of types of businesses, and it's very flexible. Alright, this is smarthelping.com. And if you want to purchase this template, I sell these, so it'll be at smarthelping.com. The link in the description box below will be a link to the page where I just built this. And all you have to do is just, it'll be a one-time fee. I'm not sure. I think I'll probably do $125 on this one, one time. And all you have to do is just pay it, and then I will send you over the template. For any services or upgrades for functionality that are not covered in the scope of this, I just charge an extra $50 an hour, and we can talk that through to see kind of what you want and how much time it might cost. To give you an idea, I probably spent about 6 to 8 hours building this entire thing, so it doesn't take me that much time to make adjustments for what you need. Alright, now that's it, and I'll see you on the next one.